Google stock jumped after coming out with stellar Q4 and full year 2021 financial results. In this video, we will model Google intrinsic value and establish whether Google is still a buy. Spoiler alert, Google is indeed a buy at these prices, despite the jump today, and it's even 20% undervalued. Welcome back everyone to the Modern Investing channel, and let's dive into today's video. Alphabet is the holding company for Google, which needs no introduction. Alphabet is actually a collection of several businesses, the largest of which is Google, which reports as two segments, Google Services and Google Cloud. Google Services core products and platforms include Android, Chrome, Gmail, Google Drive, Google Maps, Google Photos, Google Play, Search, and YouTube. None of these needs introduction. And the other one is all non-Google businesses, collectively called Other Bets. Other bets include earlier stage technologies that are further away from the core of Google business. These are the high risk, high reward plays. Looking at how Google generates revenue, Google services make money primarily by delivering both performance advertising and brand advertising. Performance advertising delivers relevant ads that users click on, leading to direct engagement. Google will then get paid for every click. Brand advertising instead helps enhance user awareness and affinity with advertisers' products and services through impression heads. Google Cloud Platform, which contains apps like Gmail, Docs, Drive, Calendar, Meet, and more, generates revenue primarily from recurring fees received from Google Cloud Platform services. Let's then move into looking at Google's financial metrics. Revenues, net income, and cash flows from operation grew steadily and impressively over the last 10 years, generating a compounded annualized growth rate of 21 to 24%. Absolutely amazing for both top and bottom line growth. Property, plant, and equipment, which represents the capital expenditure, also grew steadily with a compounded annualized growth rate of 25%, so slightly faster than revenues, net income, and cash flow from operation. And therefore, when we compute free cash flow, which is simply operating cash flows minus the capital expenditures, we get a 20% compounded annualized growth rate, which is slightly lower than the previous figures. There were a few hiccups with the free cash flow, diminishing from the year before in 2012 and 2017 and 18, but nonetheless absolutely amazing consistency in compounded cash flow generation for the business over the long term. Share outstanding increased up to 2018, for then starting decreasing thanks to buyback programs. Given the consistency in cash generation, it is expected that they will keep on decreasing in the years to come. Thereby, this is being the main way shareholders will be compensated. If we look at margins, gross margins came down over the years, from 62.7% in 2012 to 56.9% in 2021. This is not great to see. It means that it costed more and more to produce their product in 2021 in comparison to the revenues as compared to what it did years ago. So the production costs are going up. However, on the positive, it did rebound a bit from 2020. If we look at the operating margins, which is the gross margins after you factor in operating expenses for running the business, such as salaries, ordinary maintenance, etc., also we can see a decrease over the years, but rebound aggressively in 2021, printing the best year in the last 10 with the operating margin of 31%. Net profit margin, which is the operating margin after you factor in taxes and interest payments, followed the same trend as the operating margins, with a strong jump in 2021. Free cash flow margin, which measures which percentage of the revenues results in cash available to the business after all cash expenses have been paid, was more volatile, ranging from a high of 29% in 2012 to a low of 16.7% in 2018. In 2021, it rebounded to 26%. However, the average over the 10 years has been 23%. So when in a minute we will predict future cash flows, we will use this average 23% figure. Overall, I love what I see here. Consistent fast growth in top line and bottom line, as well as fast growth in free cash flow, and a tendency for diminishing the share outstanding in the last few years. Furthermore, the jump in margins in 2021 is a very good sign, signaling that they are not on a progressive decline, but they can normalize and even get better going forward. Let's now move to the predictions for the years to come. In the first row here, we have analyst estimates for Google revenues going forward. For 2022 and 2023, I took the consensus analyst estimates of $297 and $342 billion, which would represent a 16 and a 15% jump from the previous year. These are lower than the 21% compounded annualized growth rate that they enjoyed in the past decade, but it is fair to assume that as Google becomes bigger and bigger, its growth rate will slow down. Personally, I'm very bullish on Google's future. Their moat becomes bigger and bigger every year that passes by. Emerging market, internet penetration, and digitalization keeps increasing, adding a growing number of users to their ecosystem, and they keep on innovating at a staggering pace. However, I will strip away my biases and try to keep these numbers as conservative as possible. So I decided to keep on decreasing Google growth rate in the years to come from the 15% of analyst estimates in 2023 all the way down to 5% in 2031 to reflect its sheer size will slow its business down. This gives us an estimate revenue numbers over here. Next, we need to predict Google free cash flow margins going forward, and for that, I chose to keep them constant at 23%. We have seen that the free cash flow margin fluctuated over the years, and 23% has been the average for the past 10 years. Moreover, this past year they reported a 26% free cash flow margin, so I feel like a 23% is not too optimistic, but rather a fair long-term estimate. Multiplying the revenues by the free cash flow margin gives us the predicted future free cash flows values that you see in this row, which have a 10.2% compounded annualized growth rate. Let's move to the discounted cash flow valuation. In green, there is the free cash flow values that were just reported, and these values are the predicted free cash flows from this year to 2031 that we just calculated. In the row below, there are the discounted values. I chose a 7.4% as the discount rate, as you can see in this cell. This is also called the weighted average cost of capital, and if you are curious about how I calculated it, you can stop the video here. Next, we need to calculate the terminal value in year 2031, and to do that I calculated it with two different methods, and then took the average of them in these cells. The two methods are the exit multiple and the perpetual growth rate. For the exit multiple, I look at the historical price to free cash flow values from 2006 to today, and as you can see, it has been very volatile. I always try to be slightly pessimistic in my calculation, so I decided to take the average of the period, which is 22. 22 of course is lower than what it is trading now, but in 2031 I expect that a lot of Google growth has been depleted, and therefore it is fair to assume a lower multiple. So a 22 terminal multiple gives us the terminal value that you see here. For the perpetual growth model, I assume a 2% perpetual growth rate, and that gives us the terminal multiple over here. And this is the average that I mentioned. In this cell we have the sum of the future cash flows together with the average of the terminal multiple, and here we add cash minus total liabilities, and here we divide by the share outstanding, which gives us a fair present value of Google share to be $3,666, which is about 20% higher than what the stock is trading at, signaling that Google is undervalued and potentially a buy. To wrap up, there is a number of reasons to like Alphabet as an investment. Google has one of the biggest business moats in the history of business. Its ecosystem becomes bigger and better by the day, and I cannot see that to change in the foreseeable future. Google has an amazing balance sheet with more than $140 billion in liquid assets and only $21 billion in total debt. I wish I had that kind of piggy bank. Users' behaviors and advertising continue to shift online as the digital economy evolves. More and more people, especially in emerging countries, use Google services, and this adds new customers. To add to that, Google managed to build such an empire due to its culture of persistent innovation. I want to read you through a passage in their shareholder letter, which I find extremely inspirational. And here it goes. Many companies get comfortable doing what they have always done, making only incremental changes. This incrementalism leads to irrelevance over time, especially in technology, where change tends to be revolutionary, not evolutionary. People thought we were crazy when we acquired YouTube and Android, and when we launched Chrome, but these efforts have matured into major platforms for digital video and mobile devices, and a safer, popular browser. We continue to look towards the future and continue to invest for the long term. As we said in the original founders' letters, we will not shy away from high risk, high reward projects that we believe in because they are key to our long term success. I love these words, as I mentioned. These mindsets of constant innovation at any cost is what brought them where they are. I wouldn't bet against it. With that said, we must also face the risks. The biggest one is without any doubt regulatory. They are, in many aspects, a monopoly, and that is a no go from a regulatory point of view. Especially the Play Store, which takes a 30% cut from purchases. And developers have no other way to go around it, since Google and Apple are a true duopoly in that sense. European governments are also on Google's neck, and every year they come with a multi-billion-dollar fine for breaking one or another competition law. For Google, it doesn't matter, because paying a few billion fine is like peanuts, but there is the risk that it might escalate in something more serious. Also, the European Commission has proposed a directive to ensure a global minimum effective tax rate of 15% for large groups operating in the European Union. And this means that Ireland, the low tax European home of Apple, Facebook, and Google, will raise its corporate tax to 15%. This will have a negative impact on Google profits, and we shall see in the future earnings how much of that impact that will be. Lastly, the portion of revenues from non-advertising services such as Google Cloud, Google Play, hardware products, and YouTube subscription is increasing, and this may affect margins. Each of these segments have different margins, and we shall see in the future if that will increase or decrease margins. By now, it is an unknown. In conclusion, Google is a buy for me. It is trading well below my calculated intrinsic fair value of $3,666 per share. Combine it with its extensive moat, innovation culture, growth in many years to come, and pristine balance sheet, I think it is a good investment opportunity. I don't own any share, but I'm tempted to add at these prices. In this last conference call, they also revealed that they will split the stock 1 to 20, so the price per share will become around $150, and it will be more convenient to dollar cost averaging. All that said, Google's success is also the source of its headaches, and we shall see how much the regulatory pressure will affect its business going forward. That's it for today. I hope you enjoyed the video, and if you did, please click the like and consider subscribing. And let me know in the comments below what you think of Google as an investment. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.